I'd rather improve my probability of success by being a little bit more patient and being a little bit more thoughtful and intentional about how I do this. And so much of it comes from.
Thank you so much for tuning into Journey with Christian Evans podcast. I'm your host, as always, Christian Evans. This next guest is the financial maestro with a passion for crypto, sustainability, and art. Former Deutsche Bank whiz turned placement agent. He rocks the niche credit strategy scene, managing partner at Cedar Ridge Capital. He conducts symphonies of institutional relationships while wooing with his credit and security analysis skills. With a BS in finance from the University of Scranton and a CFA charter holder, he's a conductor of success. Armed with Series 7, 63, 31, and 3 registrations, he's a virtuoso in the financial realm. When he's not making magic happen, you can catch Joe, my guest, attending Renaissance revival events, providing that even finance wizards have a taste for the extraordinaire. Please welcome my next guest, the one and only Joe Azzaro. How you doing today, Joe?
Good, Christian. How you doing? Thanks for having me, man.
Man, I'm looking forward to this conversation, and I want to, dive right into. Obviously, we're going to be talking about some of your cool deal flow that you're working on, very unorthodox, and as well as your curated way you build synergistic relationships. And we're going to be diving into a lot of that fun stuff. Definitely the microeconomy with the micro stuff's going on and how you navigate this uncertain times. But I want to dive into your journey from Deutsche Bank to placement agent, to unpack that a little bit, because that's totally out of the ordinary, totally different, two different verticals. Help me understand how you went from Deutsche Bank, obviously working there for several years, to then get into the placement agent.
Yeah, I mean, actually, I had started interning at Deutsche Bank when I was like 18 years old, right? So I was almost like, I had been interning every summer and winter, just keeping my foot in the door. And effectively, after about 3-4 years there working full time after the graduate training program, all in the credit space, I met the CEO of a placement agent business in a CFA class. It's interesting. When I was kind of thinking about my career, it was either like an MBA for your network or your CFA to kind of just get, an inch deep, mile wide into some different financial instruments and really understanding the finance ecosystem. And funny enough, I ended up networking in the CFA Sunday review class with the CEO of a broker dealer in New York called Stonehaven. And actually, you met David Frank. You interviewed David Frank some time ago on the show. And so I got to know David Frank just from sitting within arm's reach of him. And he said, "What are you doing as a credit analyst?" He's like, "You got a great personality. You should be out talking to investors, talking to people, building relationships." And after I graduated in 2007, I really wanted to get into sales, but every sales desk at DB was shrinking. And it was sort of like this chicken or the egg situation where nobody would give me the job without the experience, and I couldn't get the experience without the job. And so I was kind of chasing my own tail, and people were like, "Hey, Joe, you're great, but I've got to fire 3 people for my team in the next year." So eventually David Frank said to me, "Hey, keep in touch with me in the next 3 months. I'm going to have a job for you." And I kept in touch with David Frank every 3 months for 3 years. And then finally he called me at my desk at Deutsche Bank and said, "Joe, I'm so sorry. I've been stringing you along for years, but if you're still interested, you've proven to me that you have what it takes to be a salesperson because you've sold me through this whole like long journey." And I went and met with his partners and effectively just started running West Coast distribution, mostly focused on hedge funds, selling hedge funds into the top 1,000 allocators all along the West Coast. So you're talking new money mostly, which I thought was really interesting about covering the West Coast. It was a lot of family offices, within the tech space. And I was just building relationships from the ground up. I literally knew no one, Christian. So it was cold emails, cold calls. I'm Italian. I'm a skinny foodie and I love food. And so I would go, if I'm going to San Francisco, I would just book a reservation at one of like the best new restaurants for 10. And then I would just start building, filling those seats with family offices and saying, "Hey, I've got a table at Rich Table for 10, next Thursday. Do you want to come? I've got these families coming, and all of a sudden just, really at the end of the day, big piece of this job and kind of transitioning for me, building and those relationships through adding value first, right? These allocators, they all want to know each other. They're all looking at different deals, and some of them have an expertise in real estate. Some of them have an expertise in venture. And so if I can help connect them so that when they see deal flow in an area that maybe isn't in their expertise, they can reach out to their newfound friends and say, "Hey, what do you think about this?" Right? And so to be that point of contact and that sort of, channel for them to get to know each other is important for them, but also important for me over time. So yeah, that's how I kind of made the transition. And to be honest, Christian, it's actually really helpful to have an analytical mindset in a sales seat, or at least in a capital raising seat. Because you're really only as good as your product, right? And so when you're going out and talking to people, to have an understanding and to think like an investor when you're looking for things, right? That really helps you find unique ideas. And then also when you're communicating those ideas with investors, those investors are going to say, hey, investors are very funny. They're always looking for a reason to say no. There's so much deal flow being thrown at them. They're looking for a quick, no, thanks. That's not it. Here's why. And if you really understand these strategies and you really understand the risk involved, you can kind of at least dance toe to toe and kind of say, hey, maybe you're not thinking about it right. And here's why. And I think having that deeper level of understanding has really been influential and helpful for me, at least in my career.
So let's dive into this, because I found the evolution, just even your outreach, was very interesting and how that evolved. And then, of course, I want to talk about the way you're able to align investment thesis and deal flow according to your LP base. And I thought that was actually very interesting as well. But the evolution, you said you started out, you didn't know any relationships, just like anybody. You don't know anybody in this industry, but yet you went out there and just started cold calling, cold emailing. And then all of a sudden it evolved into more of building relationships with, obviously food. And that is an amazing adaptation towards your journey. What did that phase look like specifically? Did you start doing cold email, cold calling, and you realize, okay, that's working, but it's not as effective as, say, obviously that food approach? What were your thoughts, or the way you analyzed your approaches, and obviously how you were able to fine tune it?
Yeah, I mean, in the beginning, Christian, it was just like dealing with no a lot, right? Like, you're just also just leaving voicemails and sending emails into this black hole of nothing where nothing ever comes back. Nobody responds, and just dealing with that and being okay with that and recognizing that there are little victories along the path and along the way to the bigger victories that you kind of have to, those little hurdles you have to get over. And they kind of give you momentum along the way. And sales is so much about momentum, within a process. But, other ways that I really found to be helpful was when, instead of just hitting your head against the wall, sending the same email, calling the same person, get smart, start researching those people, understand, these are humans as well. These people have all had different, pieces of their life that are important to them. Understand who they are, go the extra mile when others aren't, right? And really do your homework, and then connect that to your own story, right? If you're just sitting there throwing spaghetti at the wall saying, hey, look at this, look at this, look at this, people get tired of that, and I think for me, at least, not having a real sales training through an earlier part of my career, I had to learn that the hard way at times by going a little too far in moments, right? And that was something where it's trial by error, right? You're going to figure it out as you go. You're going to learn by trying, and sometimes you're going to fail, and that's only going to help make you better in the long run, right? And so other things I love to do with clients is, once you understand a little bit more about a person, I saw somebody, the CIO of a big family in New York, I saw his name. I'm a big racket player. I love squash, ping pong, paddle, anything. I'm very fast and I'm long, so I can get most places on a court pretty quickly. And so, like, I love the competition. I love the athleticism. I love to sweat, right? And when you can do that with another person, it builds a deeper relationship than just, how many times have you just went out for a beer with somebody, and it's just, it kind of just melts into your mind of just, I've done that a zillion times. And, even nice restaurants, you've done it a million times. But if somebody else is passionate about a sport, about an activity, I've went rock climbing, I've played squash, you go on runs, you just play pickleball, whatever the thing is, I have meetings at Art Basel where I know there's other investors that are there. And I know that they have a passion for art, as do I. And so find those common denominators and link over that, right? And because at that point, that person's guard is down. My guard is down. I'm not even thinking about sales. I'm not even thinking about business. It's just, here we are as two humans engaging in something that we both enjoy. That's where the magic happens. And then from there, the beautiful thing is at some point, then people say, well, so, hey, what do you do? What is it that you're working on? What is it that you're excited about? And then it's organic, And so for me, so much of this was about doing research and also just doing things I enjoy, and I tell that to so many people. It's like, I am very unconventional in how I build and find relationships. Like I said, there's, I think in a large way, being at those centers of gravity where the people are who you want to know, those target rich environments, and not even trying, but just it happens. There's a flow to life. And, at Burning Man, at, Art Basel, being, in the Hamptons in the summer, being in Jackson Hole in the winter, being, being in Europe in the summer, right? It's like in these areas, if you just go out and live your life, do the normal thing you want to do, you're going to meet the right people at the right time just from being at the right place. That's just kind of how it goes. At least that's what I've experienced in my life.
So was there a point in your outreach that all of these ideas came to you and said, okay, hey, I got to go against the grain. I cannot be like any other capital raiser or, placement agent. I got to go against the grain, not only in regards to my approach, but also in the deal flow that I have access to. Was there a pivot point? Was there a specific moment where you're like, okay, I've done that. That's not working, or it is working, but it's just not effective. And then there was, obviously that evolution into what you just mentioned, which is incredible. And I love that approach because, like you said, you're standing above against a crowd, and people will always remember, oh man, I the ping pong game, or playing basketball, or whatever it is, or a cold plunge, whatever it is that you guys do together. That's able to like, wow, that was awesome. I remember that, and I remember this guy, and and I like that relationship. So, was there a pivot point during that?
I think it was really, like I said, sort of just trial and error. Like, I think I knew, like, in one instance, I saw this gentleman's name on a squash court record of like, hey, he's open to play today. And I was like, I wonder if that's the same guy. I'm going to email him and find out. And then what I kind of realized was, I think you have to play with life. And that's the same with work. That's the same with relationships. That's the same with dating, whatever, right? You have to take chances and try things. And at some point, the right path will just work. You'll take a chance and say, okay, I'm gonna try this. And when you notice that works, you start to feed that part of yourself a little bit more. And then all of a sudden you go, okay, there's actually something there. Like, this is better than me just reaching out via constant, mass mail, sending 200 emails, just blasting people. Because I think what's happened is, and I think this is only going to actually get worse over time when you've got these, this AI and all these mass mail campaigning solutions. And, at some point you're going to have this virtual assistant you're just going to say, hey, send out 300 emails to everybody in my contact list about X, Y, and Z. And at some point, people on the other side, they're already just like, no, I don't want to hear it. It's too much. Like, it's noise. So I think you have to do that on some level, but I think you have to do it in a more unique way where you've actually put more effort in than other people. And I think at the same time, you got to look at life and in these situations from different angles, because these people, these investors, these family offices, they're getting phone calls and emails from hundreds of people a week with hundreds of different ideas. And so how do you stand out is the question that you should kind of just play back in your head. And I think it comes down to, what are they looking for? Sales is so much about listening, and some of that listening, once you get them on the phone, once you start talking, you can ask those questions and hear what it is that they're trying to tell you and what they're looking for. And then you can be more of a value added service provider to them, to be their eyes and ears, because I've got a very different network than they may have. And so I can help them find the things they're looking for just in different channels. But the other thing I think, besides just listening, is if you can't get that person on the phone, you can't get them to respond to your email, go spend an extra 20 minutes digging. Don't just keep sending the email into that black hole. Take a step back and go, okay, that's not working. I either need to change to a different person within that organization, or I need to do a little bit more homework and actually try to build a relationship, because that's where the relationship capital gets built. From you taking your time to learn more about that person and then build that connection to them through the conversation.
Awesome. And I know we talked a little bit offline, and I thought this was kind of a cool, and I want to bring this up, where some individuals approach in regards to placement agent, that it's a quantity game in regards to like getting singles and maybe smaller checks. And you mentioned you're kind of go for those larger whales, right? Those that can deploy, a larger check, et cetera, right? And what was the evolution for that? And then, as well as when you are building these relationships, I would imagine you are strategic. You are obviously putting the work in on the front end, so that on the back end, you're obviously very, specific on who you are reaching out to, who you are connecting with. And that these individuals are able to write that check, but you're obviously first, I just want to reiterate that you're building that relationship first. That's you going into that is a relationship building, not to get the check, but that relationship on the front end. But at what point did you start going away from the singles to those larger whales?
Yeah, I think, and to your point about you can't go in looking or wanting to close that deal with somebody. Some of these relationships I've had for 10 years and I've never done any business with, you know,
Yeah.
and that's just an evolution. That's just, I can't force it. I can't push water. If you try to push, just like dating, right? If you try to really push somebody into something that they don't maybe know if they want to be in yet, it's going to slip right through your fingers. That water is going to move right through your fingers and your hands. And so it's better to just, yes, build that relationship up front. And for me, it's like, when did I transition into, just focusing on bigger checks? I think for a lot of this, what I've realized, again, it's an evolution. In the beginning of my career, I was calling anybody and everybody just to try to have a relationship and a point of connectivity and try to do some business with somebody. And what I quickly kind of realized over time, Christian, was it takes the same amount of time and effort and energy to convince somebody who has $10 million to invest $500,000 as it does to convince an institution who has 20 billion to invest 50 million, So I'd rather just take that time and energy and focus it on the bigger folks who also, and no offense to the guy that's got 10 million, I'm sure he's very smart and I'm sure he has a lot going on, but I also, part of this job is just finding really smart people and connecting them to other really smart people. And what tends to happen is that mental capital, tends to go into the larger institutions, the larger families where, maybe not always, because sometimes, you have very big pension funds that have a very simple approach and maybe they just, it's not as complex and complicated, so they don't need to be geniuses. But and there are plenty of entrepreneurs who are absolutely brilliant as well. No disrespect there. It's just, I think part of the job of what I'm trying to do is just connect smart individuals, get them on the same page, and finding those smart people, building friendships with them, right? Because at some point, it's no longer just work, right? At some point, these are just people that I have long tenured relationships with that I just enjoy talking to them. I talk to them about markets. I talk to them about what's going on in their life. I talk to them about what they're looking at, what they find interesting. And, that's a beautiful thing because then I'm not just sitting here pushing product, right? That to me is like, I hate it. It's just the worst. It's like that's not what life is about, right? Life is about relationships. Life is about building connection with people and then and across a spectrum of things to talk about and discuss and what's happening in the world. And then from there, you can uncover, that's how they view the world. That's what they're looking for. That's how I can add value to them by actually finding them something that meets their need. And you're only going to uncover that when their guard is down, they're talking, they're shooting the shit, and they're kind of just saying, hey, here's what we're looking for. Here's what we're excited about. And here's why I think it's really interesting.
Well, you're so intentional with your approach and you're so relational aspect. And it's so refreshing. That's why I wanted to have you on, because right away when we were talking for this pre-podcast, I could tell you're very relational in regards to, really understanding who you're talking to and really, and you use this word, and I love this word, curating not only the deal flow, but the way the activities that you structure these relationships on. So I thought that was really cool. I want to kind of talk a little bit. You mentioned this earlier on. I want to kind of loop back around on this. When you mention a deal flow, not only are you curated on what deal flow, it is you're very methodical in what deal flow you work with to help raise capital, but also I thought it was interesting. You don't just pitch it to your investor, Rolodex, but you kind of help them understand maybe how it could fit into their investment thesis and say, well, you mentioned, Billy Bob, that you wanted XYZ in the next 7 years. And hey, by having this into your investment portfolio, this could help get you accomplish that XYZ that you were mentioning. So I thought it was interesting where it wasn't just yes or no. You were trying to help them kind of understand how to, get it down to the goal line, if you will. What did that evolution look like in regards to that approach when you are having that conversation and maybe that individual, like right away they say no, but then you have to explain to them, oh, this is kind of the vision I'm seeing. This is the reason why I brought this curated deal to you to say, hey, this might be something along, maybe it's kind of outside of your vertical normally or outside of your investment thesis. But I find that it could be a very synergistic relationship.
Yeah, I think initially I was sort of just, you know, I was just kind of saying, okay, just push everything out there. And as soon as the investor says no, okay, fine, I back up and I that's it. I'm not gonna push back, and I'm not. But I think, sales requires a little bit of confrontation. It requires a little bit of not being afraid to have a difficult conversation. And so, I think for a while I was finding whatever came my way or whatever I was being given to sell, I was selling. And then I think as I kind of came out on my own and established my own practice and business, I started to just think more like an investor. And, in some cases it's really great, but I've had, to think like an investor and to wear that hat, is something that, maybe you're patient, maybe you're not pushing to just sell the first thing that comes because you really want to have a big trade and you really want to sell something. But be patient and wait for the right thing, because when you have a good product and you've really thought through why you think that product is valuable and important in this kind of market environment, I think that story resonates a bit more and you have a deeper understanding of what that investor is looking for. And maybe just through your conversation, you uncover, hey, they like, for me, I really like to focus within specialty credit. Looking backwards on my career, it's so clear, right? Oh, I was a credit analyst at Deutsche Bank. I really understand credit. I understand how to think like an investor and what makes a good credit opportunity versus a bad one, the waterfall structure of payments, all that. And so, looking backwards, it's very clear, but I think I have a really good, compass for finding that product and thinking like that investor and looking for things that are, there's good asymmetric returns, there's an expertise required, there's a number of different things that you could look for within that product set to basically help you find something that might be more institutional or higher quality. And really, I think spending that extra time on looking for those things is so worthwhile. And that's really, I think, where from there, you're going to be bringing people things that are more valuable to them. And in some cases, it's, I'm playing more of a role of maybe I don't have that product myself. Maybe I tend to only work with a couple of products at a time. I don't want to be the guy with the raincoat, like, hey, what do you like? What do you like? What do you like? I try to just, have a couple of good ideas within a vertical and focus on those and really become more of a product expertise in those areas. And then, I think, but because I'm affiliated with a broker dealer, Stonehaven, that has, all of these there's 50 other brokers like myself that work within that platform. So if I talk to an investor and they say, hey, I'm not actually looking at specialty credit right now, I'm actually looking for venture. What do you have in venture? Now, if I don't have anything, if I'm not working with a manager in that space, I can go down, the broker dealer menu and kind of look and analyze and try to find, maybe there's 5 or 6 different things within venture there, but I can find the best one and then basically, act more surgical, act more like a sniper and just try to connect that one shot. And for me, that evolution of less is more has been just, it applies to everything in life. It helps you to understand your product better because you're not juggling 50 things. You can deliver a higher quality product to not only your investors, but also to the managers who you're working with and servicing.
Yeah, it's so powerful because I got a friend of mine. He's got a huge ecosystem, and what I realize is it's just a Rolodex of basically 20,000 investor emails, and then he's got a ton of deal flow, and he basically pushes out a newsletter or email and say, "Hey, this is what we've got. Do you want some or whatever?" And what I realized was that became a commodity, and I like where you obviously elevated yourself, where you only work with a very very small amount of deal flow, but also maybe some Rolodex and make that alignment, like you just mentioned. I like that analogy, the sniper like, right? You are making a very intentional one kind of hit, and you're very, very focused on what that looks like. Now, let's turn a little bit our focus toward your methodology and your criteria. Like you mentioned, less is more, right? So you are only dealing with a handful of companies. Everybody and their mom is looking to raise capital in today's market, and everybody's looking, for money. And I know it's easy to find deals that are like, hey, we want to, can you help us raise? Can you help us raise, et cetera? And you may or may not know some people that are interested in that deal flow, but you have to say no a lot of times, right? Those that are successful tend to say 90, no to 90% of the things and only focus on maybe, the top really 10% or maybe even the 8%. My question is what is your methodology? What are you looking for? Because I know you mentioned offline, you've got some really cool deal flows. I know you obviously mentioned, the private credit, but you also mentioned a friend of yours, the intellectual property kind of thesis, which I found that very interesting, in the commodities as well. What is the way you think about it in your methodology, your criteria? Does it have to hit a certain kind of criteria to say, okay, hey, I'm willing to open up your Rolodex for this specific deal? What does that look like?
Yeah, good question. I think it's a number of factors, right? And again, it comes back to thinking like that investor, and it's so much more of an art than a science. It's not like a formula like, oh, if they have, this amount of AUM plus this amount of people in the team and the return stream looks like this, then that's a good manager. It is a feeling, right? And some of that. So first off, there's people, right? It's like the people, the process, the performance. Those are like the 3 Ps in a way, right? And the pedigree of those people. Where did they come from? What kind of experience do they have? What gives them an edge relative to the 30 other people that are doing this, right? And I think that is something so important because, again, even when I bring an allocator in, it's people to people, right? I'm just a matchmaker. I'm just bringing 2 people in a room together and saying, you're smart, you guys should talk. There's an interesting opportunity for you both to make a lot of money together. Go. And if they do, then I also win. Everybody wins. They win, I win, the manager wins, investor wins. It's great. So for me, it pays to spend a little bit more time and be a little bit more thoughtful about building that portfolio of like what arrows I have in my quiver. And so, a lot of it is, yes, what is their performance? Of course, I want something that is going to have a juicier return, but it's also relative to the risk that you're taking to get that return. And so that risk reward functionality is super important. So if I can get a really high return, but there's a ton of volatility or a ton of risk associated with it, these guys are like doing some crazy strategy out in the middle of who knows where. And, it's highly skeptical and there's a lot of, gut macro risk, whatever. Maybe I just don't know the people that would find that interesting. That could be a great deal. That could be a great opportunity. Those guys could 10x your money in a week, but I just might not know those people. And so I think it's so much about who are the people? What are they doing? Where is their expertise from? Why do they have that expertise? Is it sustainable, that expertise? What is the risk they're taking to generate that return? And then also, how are they thinking about building the business over the long run? A lot of these allocators, what's great is they want to work with people that they can work with over the next 10 years, constantly selecting new product, new managers, new hiring of new managers. It takes time. So if you can find a young team that's doing something unique and they're building a long-term business in a space that's emerging, then, then the allocator can cut a check today, do all that homework up front in year 1, make the investment. Maybe typically they start with a smaller amount, and then on fund 2 or the next re-up, they tend to do less work. They still re-underwrite the manager, but it's less work. They've already done the large majority of the work up in the front. And then they tend to scale up and write a bigger check. And then fund 3, they write a bigger check. And, it's like they can grow with these people. So really, I'm looking for niche and inefficient spaces where there's people that are taking advantage of that inefficiency, where there's asymmetric returns, where there's like the downside is capped and protected, but you've got a nice strong upside with, potentially it can be equity like in a way, but maybe I'm getting very consistent cash flow along the way. So yeah, so much of it is a feeling about the people. And then of course there's, the performance and why are they better than everybody else? And so, a lot of times I'll get an introduction from a friend who says, hey, can you look at this? I have a friend of mine who's raising money over here for this thing. And I'll look at it and then I'll kind of just, say, okay, do I know anybody else that's doing this that's better? Right? There's kind of like, there's got to be a bar for why I'm going to work with that person relative to anybody else that's doing the same thing out there. And then the other side of that is, do I even know the right people? Is this a high net worth product? Is this a family office product? Is this institutional, right? And that gauge of if something is institutional, I always say this to managers, it's not a formula. Again, it's a smell, it's a taste. It's something that like you can't just do A, B, and C, and now you're institutional. It's like, it's how it's, Kurt Cobain from Nirvana has this song, Something in the Way. And there's something in the way that you do things. It's not just what you do and how. It's something in the way you present yourself, you hold yourself, you walk into a room, people can sense that you have the confidence, you are a serious real person in a way. And so that's kind of the makeup, and then over time, Christian, even within certain spaces, I've had investors come to me and say, hey, can you help me find a quant manager, and he's got to have A, B, and C characteristics. He needs a Sharpe ratio of Y. He needs, volatility can't be more than X, and the biggest drawdown can't be more than Z. And you start to hear that, right? And yeah, of course, I can go out and just try and look. And I've been looking and uncovering and trying to find that quant manager. But also that influences and shapes how I'm now looking for product, right? Oh, okay. If that's how you think about the world, Mr. Allocator, that's going to cut $100 million check into something, and you think that's the defining qualities of a really high quality product, I need to now incorporate that into how I go out and move through my network and landscape looking for those things. Because if I go out and, take a product that's got a 1 Sharpe or less, and, there's people out there with a 2 Sharpe, it's going to be a tough battle. I'd rather improve my probability of success by being a little bit more patient and being a little bit more thoughtful and intentional about how I do this. And so much of it comes from really listening to how other people are thinking about the world, who are smarter than me, who have been doing this much longer. And just slowly over time, you get smarter and smarter and tighten up the process until it's more efficient and it's just streamlined. And, what I've also realized within relationships, after 10 years of knowing somebody, there's so much trust built that to convince them. And by the way, I'm convincing nobody. The people I'm engaging with are so much smarter than I'll ever be. And it's more just showing them something that I think is valuable for them, right? Or that I think they should look at, because I think it's a novel and unique way of approaching a market and a space. And so, after 10 years and longer of knowing somebody, it's not as much of an uphill battle. It's, it's a conversation. Hey, what are you looking at? What are you doing? Oh, I've got this thing, it kind of fits that box of what you're trying to fill. Would you be open to a conversation? Yeah, sure. Joe, we trust you. We've been working with you for a while. You bring us good things. So yeah,
It's so incredible. And like you mentioned, I mean, you got some relationships and LPs that you've got a relationship for the last 10 years, but never had actually done any business. But it's that whole contextual. You probably still showed them deals. You still probably showed relationships. You still probably went out and played ping pong together or whatever it was. But it is that, like you mentioned, that comes down to you will do business at some point. And then obviously you've done business with other individuals as well. And they have, wrote a $100 million check. My question to you now is a little bit in regards to kind of the macro economy. Things are changing drastically. I've noticed a lot of my family offices, every family office has their own kind of investment thesis, their approach. Some focus on different verticals, and there's tons of different verticals in this ecosystem, which I found very interesting. And I know this is constant evolution. It's constantly a journey. Things are always changing at the macro economy. I'm seeing a lot of capital slowing down from the VC world and being deployed there. A lot of more capital, sitting on the sidelines in the private equity world. Some are going toward and deploying capital in just direct deals. I'm seeing a kind of a shift toward a lot of family offices deploying just toward direct deals and more of operational kind of approach, and some that are going for more of a fund approach, because definitely in the generative AI they may not have the expertise, and so they kind of rely on those funds and those analysts to be able to help them deploy that capital. What are you noticing when you were talking and dialoguing? I know, obviously the landscape constantly changes, but what are you noticing in regards to the heartbeat of today and, at the macro economy right now, what you're noticing with a lot of your LPs, where they're deploying, what's kind of sexy, what's engaging, what's creating a lot of conversation around some of the topics or some of the verticals that they're deploying capital toward?
Yeah, great question. And I think, it is so challenging to answer that, because obviously there's so many different walks of life. Everybody's doing different things. Everyone has a different approach. Some people are, there's been this whole denominator effect, right? Where, public portfolios have decreased in value. And so therefore the private portfolios, when it used to be maybe 50-50 public and private and liquid and illiquid, because the liquid portfolio has dropped in value on a pro rata basis, the illiquid portfolio is now 60% instead of 50%. And so many folks are actually kind of sitting on their hands, kind of saying we need to really get more liquid in our portfolio so that we're not over allocated to privates and illiquids. And so selling illiquid investments in long-term 10-year plus life vehicles in this kind of environment is harder. And in general, the fundraising environment right now is harder. People are more patient and waiting and selective, and they're in no rush to do things until the macro economy feels safer. Now, some institutions just have cash constantly coming in that they need to allocate, and so but they're not writing probably as many checks as they once were. And so yes, while direct deals, you've seen many families kind of get into that space. You've also kind of seen, from what I've heard, is many families have just been kind of like shooting from the hip at direct deals, like, oh, that sounds interesting, yeah, bang, that sounds interesting, bang. And then what they realize when they then take a step back, they say, oh, hold on a second, now we have this like blob of a portfolio of these like 50 direct deals with maybe exposures that overlap into different areas. We've got way too much exposure to automotive, and we didn't even want that or realize that, because we've just been shooting at these things without like a top down investment policy statement of, we want to have this much allocation to private, we want to have this much allocation to venture, we want to have this. It's like when these sexy deals come, sometimes it's almost too hard to resist and say no. It's like, oh, they sound, it's storytelling, and the direct deals, sometimes it's so, it is exciting. And so I think what you'll kind of see is people are playing a little bit more into the liquid space. So maybe hedge fund strategies, active management, things like that. People are also using products and solutions that are much simpler. When you've got, a risk-free rate at over 5%, why do I need to really go down the risk spectrum and take more and more risk for, 7 or 8 or 10%? You can just use simpler investment products and instruments to get to your return targets. And so that's been an interesting thing. But also, I think with so much uncertainty in the macro economy and where the equity markets are going, if you can get a straight 12 to 15% net return via a credit product, right? That's kind of an equity-like return with secured credit, products. I think that's also really interesting. And so, when I read a report recently, where are the funds going? Like, where's the fund flows happening? And you kind of saw, it was coming out of private equity. It was even coming out of private credit. It was basically coming out of everything except secondaries. Because what you saw was this denominator effect is forcing some groups to actually liquidate some of their illiquid investments to free up more capital to put into liquid markets. And so, secondary funds were actually, in a very interesting space and a very interesting opportunity. They tend to do well in periods of market stress because you're able to purchase things at significant discounts. And just, you have a much shorter J curve effect, that the duration is shorter than a regular long-term private equity or venture lockup. So instead of being locked up for 10 years, maybe it's locked up for 5 years or 6 years or 4 years, So I think that's been an area where I've been seeing appetite and interest. And that's largely a derivative and function of, I think people got a little bit too illiquid in privates, because what's nice about privates, if you are a big institutional allocator, if you're in really liquid hedge fund products or market-based products, every quarter when you're at your board meeting, you've got to explain why, they go line by line and they just look at, okay, which funds are down a lot. Oh, why are we in this? Why are we in this? And every quarter you've got to kind of justify the bad things in your portfolio. Whereas when you lock up your money in illiquids and you set it and forget it, right? It's kind of like, oh yeah, it's working. It's not mark to market, so who cares? It's a 10-year investment. It's going to be fine. And that has, I think, alleviated a lot of internal bureaucratic stress for many of these institutional allocators.
Let's dive into the secondaries, because the secondaries I find interesting because there is this discrepancy between the buyer and seller right now in regards to price. Because some of these companies were valuated, let's just talk about one example. A few months back, the valuation was $100 a share. Now they're asking $20 a share because the valuation drastically decreased, and we're seeing that in the secondaries, that is. My question is, because there is a discrepancy, because between the buyer and seller, the seller may not want $20. Maybe they want 80, 90 or whatever, like the past valuation. But the buyer's like, well, no, I'm not going to buy, $80 now, because now it's a buyer's world. And they're saying, well, I'll give you $30 for this share and so forth. So you're exactly right. There is this opportunity for growth in that regard. But I'm noticing there is that discrepancy. Do you feel like that will iron out and the market will embrace that at some point, that discrepancy and between the buyer and the seller? Or do you think that's just going to be kind of a longer timeline and getting that up and running?
I think it really depends how badly those LPs need that cash, right? And hey, I'd love to get $450 for this pen, right? I don't think anybody's going to pay me $450 for it. The market might be $1, right? How much you want to pay me for this? It's not really worth that much. And if the market's telling me that instrument or that product is only worth 20 cents, yeah, I can hit and hum and haw and say, hey, I want 80. But one of two things is going to happen. You're going to sit in that trade until it unwinds, which could be 5 or 6 years, or you're going to sell it for what the market's going to give you. And maybe you'll meet somewhere in the middle at, 40. But, finding that buyer and meeting in the middle is really a function of how badly do you need the liquidity. And unfortunately, what will end up happening is if that seller does need liquidity, he's going to get burned. And so I think, in some cases, Christian, when family offices go direct, that the case for direct versus funds is, okay, well, if I go direct, I don't have to pay a fund manager all these fees and, that's better for me. But what you kind of also have to understand is when shit hits the fan and things get a little ugly and that, you need to get out. If you can't unwind that trade yourself or you can't, work it out yourself or sell it on your own, that asset, whatever it is, having a fund manager in place that has an expertise, that has a network in a space is going to extract more value for you and protect your capital in that sort of draconian scenario relative to just doing a direct deal where, hey, good luck, figure it out on your own. You're a big boy. You don't want to pay a fee. So now you've got to sort it out. And so a lot of times that's a challenging conversation or a challenging situation for these families to evolve in these meetings. But, that's the reality of the situation. That's why you work with a manager.
Well, I always look at it like a good analogy is like, having a property manager that knows how to run a real estate. Okay, they can take care of the renter. They can take care of the fixed toilets. They can take care of all this stuff. Yeah, they cost a little bit extra, but guess what? They take care of a lot of that stuff, like that fund manager. Or you could just buy the real estate yourself, but now everything relies on you. You have to take the phone calls with these tenants. You have to go and fix this. You have to go and fix that. And you're exactly right. A lot of these family offices are like, hey, let's do these direct deals because it's you have more control. But sometimes with that also comes a lot more responsibility. And it's like, oh, I didn't really want all this. I didn't really want to sign up for all this. So it is an interesting dynamic and foundation. Now, I'm somewhat familiar with the secondary market. I deploy some in the secondaries and the VC in regards to capital. I'm always intrigued. I am not really very well versed in the private credit. And I always found this play a vertical, very interesting. And I've got a lot of friends. I understand the concept because the risk reward is actually very, very secure. And I just want to ask you in regards to some of your portfolio, you don't have to mention their names or their deals, but how do they look at it? What are the certain KPIs or metrics that they're optimizing for in regards to that specific vertical of the private credit? I would imagine they're looking for assets that have some sort of just help us understand how a lot of your LPs kind of structure how they're looking at these deals, specifically in that private credit vertical.
I think private credit has really kind of blossomed because a lot of banks have kind of stepped out of lending due to regulatory capital requirements. And so it's created this nice white space for private capital to step in and lend money at really attractive rates of return, right? Where they don't have those same regulatory requirement, needs of a bank. And so I think how a lot of investors look at private credit is sort of a fixed income replacement. So, while you had these low rate environments, with easy money, private credit was this solution to, okay, you'll have to take some illiquidity risk and you'll have to lock your money up for 5 to 7 years, whatever it may be. But if I can reliably get an equity-like return of, depending on the space you're in, right? Not all private credit is created equally. I prefer the nichier, kind of more off the run I prefer stuff that really requires an expertise. because that's going to build a moat around your space where competition isn't just going to step in and eat your alpha up or eat up your excess return. Whereas if you're just you're just a lower middle market private credit lender, anybody can step in and lend to Joe Schmo or whoever it is that you're lending to. Whereas if you need an expertise, you need a real understanding of the market. You need to know that space better than anyone. Your deal flow is going to be really unique. Your downside protection is going to be there, and your upside is going to be there, and it should be more sustainable. And so I think for many of these allocators, they're really looking for teams and people that are operating in uncorrelated and niche spaces where they have this expertise. There is downside protection. You've got that risk reward is balanced nicely where, hey, if I can get 10%, from corporate bonds or whatever it may be, if I go a little bit out on the risk spectrum, or at least perceived on the risk spectrum within private credit, if I can get 15% net, right? And I'm in my loan to value instead of, in real estate, maybe it's 70% and higher. If I can get loan to values that are sub 50% and my net return is looking like it's over, 15, then that balance to me feels better, right? I think a lot of allocators, that's how they tend to think about, looking at and investing within private credit and trying to find unique streams of cash flow. And so much of it is also about income, right? How do you generate income? How do you, for certain people, they lean more heavily on private credit. And there's been, private credit has just been this like booming space that continues to grow and grow and grow. And I think it is because, a lot of the traditional lenders have kind of gotten out of those spaces. And yet there's so many businesses that need debt to grow, and, they have assets. And so that's the key thing, is really understanding what are the assets of this business. If we had to unwind this and, step in and foreclose, who are we selling it to? And so having that understanding, having those networks and relationships within those specific bespoke markets is, I think, really what makes private credit hum, at least for me, is finding those niche markets where people are doing things a little bit differently. They're getting more return, and maybe they're not taking as much risk.
When you talk about niche markets, can you give us an example of that in regards to kind of a contextual, like where they would deploy capital in that kind of niche?
Yeah, I mean, I can give you a few. I mean, I'll just within, like, for example, factoring or litigation finance, or maybe within a commodity market, or maybe within, there's all kinds of new ways to lend, right? It could be you could be lending against patents and intellectual property. You could be lending against aircraft financing, and there's a zillion ways. Anytime there are assets that have value, it then comes down to having somebody who's an expert in that space to unlock that value, and really who understands those assets, what they're worth, and then how to effectively create liquidity around them.
Do most of your investors in the private credit space, do they like allocating it toward hard assets, or because some of these service-based businesses, maybe they don't have the hard assets, but they have other, like you just mentioned, IP and other things, and maybe the software itself, but how do you put valuation on that, if you will, and how do you kind of, loan against that? So because obviously when you have hard assets, you have something at least that you can sell, resell if everything goes to bust. And you never want to, say that that's going to go to bust, but I mean, obviously you want to have a contingency of worst case scenario, naturally, definitely when you're underwriting and so forth. So what do you notice in regards to your Rolodex of investors?
It totally depends on the investor, right? Some investors really want there to be hard real assets backing those loans, and they really want to understand, what that loan to value is in a sense. And then there's other models now where, I've seen, I'm not working with anybody like this, but I've seen people that do revenue-based lending within the technology space and software space, which is also pretty interesting, right? Because you've got so many of these recurring subscription-based businesses that have cash flows that go into the future that you can almost on some level securitize, right? And so, so much of these financial instruments and mechanics is basically trying to take those cash flows that are, in present value, future cash flows in a way, right? And just bring those cash flows forward at some kind of NPV or discounted rate. And so, I think it's all just financial engineering. and so it depends on what the investor likes. Some investors prefer to really have things they can, just do real estate. Some investors, we just only lend
Yeah,
against real estate. It's very simple. It's not too complex. Some folks love the complexity. Some folks hate it. They don't even waste my time. I have one friend, he has like this, I call it the Scott ratio. And it's for him. And he basically says, it's my brain damage to return. It's like, how much brain damage do I have to exert to understand the complexity of this strategy and what they're doing and where the risk is for the return that I'm getting? And not only just the return, but, the size of the check that I can invest into that. Yeah. So it's really, it's an interesting methodology. And so if something's just too complex, he's like, no, thanks. Not even worth my time. I don't want to waste my time, your time, their time. It's a no. Whereas, hey, if it's really simple and I can get my arms around the collateral very easily, it makes a lot of sense to just kind of say, okay, like, this is simple. I get it. And I can get a 15 or whatever the number is. That means everyone's got a different bogey of what they're trying to hit within their portfolio. And some of it's based on, hey, what our spending is, or, what we expect, hey, if our pie chart of our portfolio, if we want to have 20% to credit, but, we really want to have that piece of the portfolio generate, 500 basis points of return for us. Okay, then what do we need to hit in order to get that? And they kind of will back into their return profile, right? Based on the size they're willing to commit to it and what they really need to get in their overall portfolio. They'll kind of build their own little hurdles.
Okay, yeah, because I'm very familiar with definitely the real estate, because obviously that's very well known in regards to loaning that out, and then I'm just always interested in, like, obviously you got the HVACs, you got the plumbers, those are kind of hard assets where you have something of tangible assets, but then, like you just mentioned, there are some really sustainable and very successful subscription models, if you will, or software SaaS kind of models that have incredible revenue, but obviously how do you allocate that? So there are opportunities out there, but like you mentioned, it's dependent upon each investor. So I appreciate kind of unpacking that a little bit. I want to get a little personal for you, man. I know we talked offline, and I thought this was really interesting. You wanted to bring this up, and I wanted to bring this up as well. There was something that happened in your life where you had someone that you lost, and that moment helped you establish a new paradigm, a new perspective about your own life. And you don't have to go too much into detail if you don't want, Joe, but I'd love to help me understand what happened in that situation that helped you become the person and the way you think and the philosophies that you currently have now, Joe.
Yeah. I mean, I think loss and death in a lot of ways can teach you so much about life, right? And during, 2 years ago, I lost like 3 people that were all under the age of 42. And one of them was my best friend of like 17 years. And amazing guy, just absolutely beautiful human. And just, I think going through those sort of things in life puts things in perspective. You tend to look in the mirror a little bit more real with yourself and kind of saying, I don't know, man, for so long, Christian, I kind of just assumed I was going to live forever. I assume me and all my friends, I don't think about mortality in that way. I've been, somebody once told me, the first 30 years of your life are real slow, the next 30 years of your life are like that. And then the next 30 years are super slow again. And so it's like, I think if you don't have that intention about how you're moving through life, which direction am I going? How am I enjoying my life? Am I happy? And, asking yourself these very basic questions. I think within our society, and especially within these big metropolitan cities, we tend to just get like tunnel vision on these things that we're told are really important, to have a lot of money and to work hard and yada, yada. But really deep down, when you look at it and when you get those things and, you become successful or you have the capital and whatever else, you still have a feeling of emptiness. There's still not a feeling of like, I've made it and I'm happy. It's like, no, you conquered the mountain and now you look around and you go, shit, now what do? I got everything I thought I wanted. I don't even know now. Like I'm more miserable than ever, And I think like going through those sort of things really taught me that life's not just about making money. Life's not just about chasing the buck and working harder and grinding it out because everybody around you has nice stuff and you want to have nice stuff too. It's like all that stuff is irrelevant. I remember I passed the CFA and I bought myself a really nice watch. And within a month, Christian, I was looking at other watches. And I caught myself and I was like, hold on a second, Joe. You just got this thing that you were chasing and you're already on to the next. And now I don't wear any watch, right? I literally just don't even care to express this thing, right? Because it is meaningless. Yeah, of course it's beautiful, it's nice, and yada yada. It's nice to have this thing that you worked for and you earned and whatever, but it gives you nothing really. The happiness has to come from within yourself, and that only comes from really looking in the mirror and sitting with yourself and like being uncomfortable, you know? And I think it taught me a lot about how I want to move through life and what I want out of life. And for me, it's like there's balance. That's so important, to have balance. And balance for me is between the two extremes of life, like teetering always, never really in perfect balance, but just kind of, some way having it. And I think, that's really required. And that's why I try so much to mix business with pleasure, you know, because it shouldn't just be, just go, go, go hard, 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 just never, never stop. And of course, I love to compete. I love to be successful. I love to have wins. I'm an athlete, and that's all that is so important to me. But it's also so important to really check in with yourself as well along the way and make sure you're heading in the right direction and you're enjoying that which it is that you're doing.
And you mentioned something where you bought a watch, and then 2 months later you were looking at watches again, and you said you caught yourself. And in today's world, you're exactly right. Um, it's so easy to just jump right back into it, whether it's you're hanging out with your friends, whether you're looking at social media, and you go right back into just that tunnel vision, right? Because that's just what everybody else is doing. They're all just kind of following. And so what do you do, Joe, on a day-to-day basis or weekly basis or a monthly basis to be intentional with yourself and say, hey, am I living my life? Am I enjoying it? Am I going out and playing ping pong with friends? Am I going out surfing? Am I doing these things that light me up, and whatever? Because otherwise you just start kind of swinging back into the day to day, and then, oh, I'm just watching Netflix, or I'm just watching series, these series, these TV series, and you start realizing, well, shoot, this is not what I signed up for. This is not why I'm doing what I'm doing. So how do you stay intentional and making sure that you are unorthodox in the way you think about it, and making sure that you are living your life according to how you want to?
I think from the perspective that this thing can go at any moment, right? I could literally collapse today. I could get hit by a bus tomorrow, right? There's no guarantee that I'm going to be here for 30 years. And having an understanding and appreciation for the life that you have, I think is so hard, Christian, when we live in the society of more and more and more, look what they have, and social media just showing you everybody's perfect life. And I go through periods of time where I'm off social media and I just find it to be completely toxic and I don't want to deal with it. And I take a step back, right? And then other times I really lean into it and I'm enjoying it and this is fun and I connect with friends and I'm in Mexico, who's in Mexico, and you link up and you'd never have those connection points if you weren't connecting with those tools. But for me, I've had periods of time where I really go deep in, one whole year, I caught sunrise almost 300 out of 365 days. And every day I would run to the East River or wherever I was for business, I would run to a mountaintop and catch the sun coming over the peak. And when you're out there at that time of day, nobody's out there. And I would speak to myself, but more just giving thanks for the life I had and for the things that I normally took for granted. Thank you for sight today, another day with mobility. Thank you for having this body that is healthy. These are things that when you take them for granted, it's like you're then worrying about what I don't have, what don't I have, what should I have, what could I get? When you start your day with reflecting and being appreciative for like the basic needs I literally hit life lottery. I was born in a free country with an education. I have a great family. I have great friends, and I can do absolutely anything I want. And, having that perspective early in the morning, first time of the day when the sun is just putting on a show. I don't know, man, you ever see a really beautiful sunset? It's inspiring, but then the day's over. When you start your day with that, even if you didn't get a lot of sleep, I know it doesn't make any sense. It energizes you and inspires you throughout the day, where you just have energy and you're feeling like you're on a high, man. It's a great thing. And so I actually picked up meditation a number of years ago from a business meeting. I cold emailed a billionaire. This guy, I was cold calling the Guggenheim Foundation in the New York, the art museum. I'm cold calling them, cold calling the CIO, cold calling the chief investment officer, no answer. Finally, the secretary says, Joe, the CIO just left, but nobody else on the team makes any decisions except for the board. The board makes all the decisions. Call somebody on the board. So I go to the board, I go to the website, I go down the list of who's on the board. It's like the who's who of like New York City hedge funds, right? And then there's one name I had never heard of. So I start looking him up, right? Find an old, like literally I'm Googling, looking up. Oh, he started one of these first like, quant hedge funds back in the day, systematic hedge funds back in the 90s, like really interesting guy, self-made billionaire. I basically just guessed his email address. I found his old company, and I assumed that email address, if he had had this business for 20 years, I assumed he still had the email address and it would still work. So I sent him a couple of emails. No answer, no answer. I started doing more research on him. I find a speech he gave about life and about these two pools of energy, time and money, and how in the first half of your life, you're really focused on building up your pool of money. And then the second half of your life, you're really focused on how do you utilize your time. And I thought it was really interesting. And I think that I wrote in the subject line, one of the quotes in his email was like, the road to dissolution. And I remember kind of writing in the subject line, highlighting that fact of, hey, we're all on this road to dissolution. I connected my story to his. He took me out for a lunch at one of these private, really fancy clubs in New York City. And 70 years old, this guy gave me eye to eye, 2 hours, like locked in. There was nothing else in the world that mattered to him except me in that moment. Right. And it was so powerful and so beautiful, and talked about anything and everything. At the end of the meeting, he says, Joe, I don't care what you take out of this, but you need to meditate every single day because it's going to change your life. And when he emailed me a book called Wherever You Go, There You Are. And I recommend it. It's but that process really helps to cultivate a discipline of awareness and focus. And that helps you as you move through life to really continue to be present in the moment and aware. And don't get me wrong, so often that analytical mind can pull me back in, right? Or, I was surfing this winter in Costa Rica for a little while, and every day I was so slow, I was so chill, it was so great. And then I come back to New York City, and within a month I'm like, go, 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 go. I gotta, I'm late to this and I'm running from here to there. And it's like catching yourself. I think seeing yourself like with the watch, catching myself, having the awareness to go, hold on, there's the monkey brain, there's the sheep in me, there's the animal in me that's just going to do the thing that I'm, like that I'm conditioned to do. Well, pause, take a moment, take a breath. Is that really what I want to do? And I think that's been something, those have been tools and ways that I've connected with myself. Also, stretching. Oh my God. During the pandemic, I was sitting every day on a computer in front of a screen. And now you'll see I'm standing right now. I prefer to stand when I'm on business calls. Stretching. When you're in a really deep stretch, your mind cannot be anywhere about yesterday or tomorrow. Your mind is feeling the pain of that stretch in that moment, and you go to your breath. And that's the interesting thing. And when you're in that breath, your mind is really clear. And I think so much of that is like defragmenting your brain, allowing things to settle. And so those are the ways that I've found really helpful to kind of connect with myself. But great question, man. Thank you.
Joe, incredible journey, incredible story as well. Just reaching out, man. I appreciate you being on here big time and just talking about your expertise and experience and your evolution, your journey in regards to, capital raising and placement agents and building these amazing relationships and living your life according to how you want to, and the philosophies that you've been able to establish because of the devastation that happened, sadly, in your life, but helped you become the person you are now. Joe, I really appreciate you being on here. For those that want to reach out to you, that want to follow up with you, want to engage with you, want to just, connect with you, maybe play some ping pong or go surfing, how do they do that, my man?
I mean, you can look me up on LinkedIn. That's probably the easiest way. That's just Joe Azzaro, and with Cedar Ridge Capital. Or you can drop me an email, joe@cedarridge.capital. And would love to hear from you. Always happy to make new friends and new relationships. Any friend of yours, Christian's a friend of mine. And thank you for having me on here. It's been great to get to know you. And I look forward to seeing you down in Florida next time I'm down there.
Yeah, definitely come on down. And guys, just make it easy. All those links in his email are in the description below, so to reach out to him. And Joe, I appreciate making yourself so available. You put your email down there as well. Guys, that is my amazing guest, the managing partner of Cedar Ridge Capital, the one and only Joe Azzaro. Guys, that is Journey with Christian Evans podcast. Until next time, be uncommon if you can.